Hey everyone, 25 years ago Nifty was at levels of around 1000 and today Nifty is touching levels of around 25,000. That's 25 times growth in last 25 years. So if someone would have simply invested in Nifty 50 25 years ago, his or her wealth would have grown 25 times. But I know that some of you would have not even existed that time and some of you would be too young to invest. However, today the question is, can the Indian stock market, particularly Nifty, replicate this 25 times growth over the next 25 years? Well, it may sound insane, but it is quite possible because it's simple compounding. In last 25 years, Nifty has grown at around 13.5% CAGR rate to fetch 25 times return. And if Nifty can grow at the same rate, it would touch levels of 6 lakh. Yes, you heard it right. Even if we take a little conservative number, say 12% CAGR growth, Nifty can potentially touch levels of 4.25 lakh. That's the power of long-term investing in a growing economy like India. But here is the uncomfortable question many investors are asking. What if this growth thesis does not play out this way? For instance, in 1990, Japan was fast-growing, futuristic and booming market. And yet, from 1990 to 2012, the stock market crashed 80% and stayed flat for over 30 years. Even today, the index is barely above its 1989 high. Question is, can this happen to India as well? So in this video, we'll try to understand the Japan story. Why its stock market underperformed for decades? And can something similar happen to India as well? Alright, let's get started. To understand why Japanese stock market underperformed for decades, it's important to understand what happened before 1990s. So during 1980s, while India was trying to stabilize its economy, Japan was already firing on all cylinders. Post World War II, Japan had rebuilt itself into a manufacturing powerhouse. By the 1980s, companies like Sony, Toyota, Panasonic, Mitsubishi were dominating global markets. The world saw Japan as the future. Even the US was afraid of losing its economic supremacy to Japan. And stock markets reflected this optimism. Nikkie 225, which is Japan's version of Nifty, went from around 6,000 in 1980 to nearly 39,000 in 1989. That's a 6.5 times rally in just 9 years. Real estate was even crazier. At one point, people said that the land under the Imperial Palace in Tokyo was worth more than entire land in California. Banks were giving out loans not on income, but based on the rising value of land as collateral. It was a classic bubble, driven more by asset price inflation than real productivity gains. It was clear Japan wasn't just an economic miracle, it was a bubble in the making. So what caused this dream to crash? In December 1989, the Bank of Japan, which has kept interest rate very low for years, finally realized that things were getting out of hand. So they started tightening monetary policy. Interest rates were raised in phases from just 2.5% to 6% over the next 18 months. Now here's the thing. Most of Japan's boom had been built on cheap borrowing. So when borrowing became expensive, the entire house of cards started shaking. Investors who had borrowed to buy stocks began to unwind their position. Panic spread. And just like that, the air began to come out of the bubble. Nikki hit a peak of nearly 39,000 in December 1989, but within 3 years, it had crashed to 14,000 level, a near 65% fall. Between 1990 and 2005, Japanese stock market tried to bounce back many times. Government would launch stimulus package, the central bank would cut interest rate again, but every time the market bounced a little, it fell right back again. Question is why? So one big reason was deflation. While most countries worry about inflation, Japan was stuck with the opposite problem, falling prices. At first glance, it might sound good. Prices are falling, what is the issue? But deflation is actually a death trap for an economy. Because in case of deflation, consumer delays spending because they expect prices to fall further. Businesses see lower profit, so they cut investments. Workers don't get salary hikes and jobs become less secure. Banks stop lending as people don't want to borrow in a falling economy. So demand slows, profit fall, and the entire system gets stuck in a negative loop. That's exactly what happened in Japan. The Bank of Japan tried everything. They kept slashing interest rate from 6% down to nearly zero by 1999. But it was too late. The damage had already been done. Debt levels were too high, asset prices had collapsed, and public confidence was shattered. Even zero interest rates could not revive borrowing for business growth. Eventually, Japan had to try quantitative easing, that is, injecting money into the system to push up inflation and growth. But for over 2 decades, nothing really worked. As a result, from 1990 peak to almost 2023, the Japanese stock market gave zero real returns. Even today, when adjusted for inflation, Japanese investors from 1989 haven't made their money back. And that's why Japan became a cautionary tale. An economy that went from world leader to stagnation. A market that rose too fast and never truly got up again. So now the big question is, can what happened to Japan happen to India too? It's a fair question. When you hear things like Nikkie hasn't recovered in 33 years or Japan was the world's second biggest economy and still crashed, you can't help but wonder if India might face something similar. But here is the truth. India today is in a very different place than Japan in the 1980s. Let's break it down. So if we compare Indian stock market with Japan, is our market rising? Yes. But are we in similar bubble? Absolutely not. First, look at valuation. Japanese stock market Nikki touched PE of around 60 during its 1992 peak. Clearly not sustainable levels. Nifty trades at around 20 to 22 earning multiple, which is reasonable for a growing economy. Most large companies are profitable, cash generating and not over leveraged. Second, look at debt levels. Japanese corporates were drowning in debt in the 90s. Indian corporates today have deleveraged themselves massively since 2015. Even the government is managing fiscal deficit very cautiously. Third, look at the demographics. Japan faced an aging population and shrinking workforce. India has the youngest workforce population among major economies, which is a huge long-term advantage. Fourth reason is structural growth. Japan in the 90s was a mature economy with limited domestic demand left to unlock. India is still developing. Infrastructure, consumption, digitization, manufacturing, all in early growth phases. And fifth, look at banking and financial regulation. Japan's banks were lending recklessly with minimal oversight. India's RBI is conservative. We saw that in IL&FS, Yes Bank and other cleanup moves. NPAs have come down sharply. Credit quality is improving. So can the Indian market face correction? Absolutely. Can there be bad years? Of course. Every market has them. But a 33-year no-return scenario like Japan? Well, that seems extremely unlikely unless we completely lose macro discipline, which so far we haven't. In fact, today Indian economy has one of the best macro in the world. Our inflation is well under control, our fiscal deficit is under control, our GDP is growing at one of the fastest rate in the world. Bottom line is, India is still in its growth story, not the end of it. So instead of fearing a Japan-style crash, we should ask, are we investing in the right businesses with the right expectation and enough patience? Having said this, we need to keep a close eye on the Indian economy. In my opinion, India's demographic dividend is its biggest strength with over 65% of India's population under the age of 35. And every year, more than 1 crore young Indians are entering the working age. However, we can only leverage this demographic dividend if India creates the right environment. Massive job creation, rising wages, more disposable income, higher saving, more investment and a strong consumption growth. This creates a virtuous cycle. Jobs that leads to consumption, that result in profits, that result in investment and that result in more jobs. And that's how a 4 trillion economy can become 20 trillion in the next 25 years. There are some good signs like India is pushing for manufacturing sector, infrastructure, green energy to create jobs and sustainable growth. Then startups are generating new age employment. Then formalization via UPI, GST is slowly improving. But here is the risk. A young population alone does not guarantee growth. If the jobs don't come, it can create a big problem. I believe that today India's youth is aspirational but impatient. If they don't get jobs that match their skills and degree, it creates massive discontent. Also, the fact is there's a massive income inequality. A few skilled worker earns lakhs per month while millions earn just 10-15,000 a month. This gap can lead to political polarization, demand for freebies and economic inefficiency. Also remember that the demographic dividend is not permanent. In the next 20-25 years, our aging population will rise. And if we don't capitalize now, we'll grow old before we grow rich. So I think that India today needs job-centric policies. If we get it right, India's growth story can be unstoppable. If we get it wrong, We may still grow, but not fast enough to lift 1.4 billion people into prosperity. Another point I think we should discuss is technology and innovation. One of the big reasons Japan struggled post 1990 was because Japan could not lead the next wave of innovation. It had great companies like Sony, Toyota, Panasonic, Mitsubishi that were dominating global market mainly into hardware. But the future was software, internet, mobile, AI, and now deep tech. And that was led by US companies like Google, Microsoft, Apple, Facebook, Amazon. They dominated the global market. And now they are leading AI innovation with companies like OpenAI. I believe for India to grow at a faster rate, this innovation in technology would play a significant role. And while India has made progress with UPI, India Stack, and a growing startup ecosystem, we are still far behind the US and China when it comes to cutting edge innovation. The US continues to lead in AI, semiconductors, biotech, and deep tech. China is pouring billions into quantum computing, electric vehicles, and AI infrastructure. And let's be honest, India has missed the AI bus for now. Even though we have the talent, we haven't yet built the institution, deep research, or capital scale needed to lead global innovation. So this is both an opportunity and a warning. If we don't invest seriously in R&D, support deep tech startups, and fix our education to industry pipeline, we risk becoming just consumer, not creator in the global tech economy. Okay, let me not stress this video further. I'd conclude by saying that history teaches us that no country is immune to long-term challenges. Japan had everything going for it in the 80s and still struggled for decades. But India's story is different. We are still a young economy, a young population, and we are getting just started. Yes, there are risks from job creation to execution gaps. But at the same time, we have digital infrastructure, entrepreneurial energy, and global tailwind on our side. I'd like to be both realistic as well as optimistic. And when I look at India's demographic dividend, I choose to see the glass half full. If we invest in people, skill, and infrastructure, then India's best days are still ahead of us. And if the Indian economy would grow, Indian stock market would continue to reward the investors. Now you tell me in the comment, are you bullish or bearish on the future of Indian economy and stock market? And where do you think Nifty moving in the next 10-20 years? If you find this video useful, do share it within your friend circle. I'll see you in the next video. Till then, take care.